Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers. I'd like to welcome you back to another edition of the What We Learned in the Markets This Week video series. Now, it's often said that the bears look smart and the bulls make money. The bears look smart and the bulls make money. This is around the context that when someone calls a crash or a bad market, they go legend on us. Think about Michael Burry, the real-life fund manager behind Christian Bale's character in the 2015 hit film The Big Short, which told the stories of investors that got the 2008 mortgage crisis right by shorting the mortgage market. He's most known for predicting and investing around that 2008 great financial crisis and mortgage crash, and he's thought of as this great investor today, right? Well, how about the fact that this year he put massive put options, which means he's betting on the market to go down, on both the S&P 500 and the NASDAQ 100? A bet that probably lost billions of dollars this year. No one knew about that, right? And presumably some of you have watched the movie The Big Short, so you know him because bears look smart and bulls make money. Now, the market is positive 8 out of 10 years. Look in some decades and maybe it's 7 out of 10 years. But we don't need to look smart at Whitaker-Myers. We need and want and desire to make our clients money. That's what we want to be. We want to be bulls make money, so that we can be great stewards of the resources that God has entrusted us with. As one of my college professors once said, it's not that you have to be a steward, it's that you get to be a steward. Think of the king of the universe who needs nothing, but is giving you a chance to manage assets for his purposes. Our strive should not be trying to time the market or game the system with his assets. 8 out of 10 years, the market's positive. Again, just invest. Don't worry about the rest. And we shouldn't worry about, I'm not going to have enough because the market might get bad. Again, these are God's assets, and they're providing us with shelter and clothing and fooding. But just like he tells us in Matthew 6:25, don't worry about your life, what you'll eat or drink or what you'll have for your body, what you'll wear. Is life not more than food? Is your body not more than clothes? And then he goes on to say, well, look at the birds of the air. They don't sow or reap or store away in barns, yet God feeds them, our Heavenly Father feeds them, and are not you much more valuable than they? So this year has been such an incredible bounce back year for the markets. Even though everybody at the beginning of the year was saying it's going to be horrible, stay out of the market. True, it's not over yet, but it seems like we'll end well in double digits on the growth side of the coin. And that's just a good lesson to remember, that bulls are going to be the ones that make you money. People that are optimistic about the economy and the market. Bears are just going to look smart every once in a decade there. And you'll remember that. But that's not how you invest. And that's not how people grow wealth over time. Tortoise and the hare, Aesop's fable. Now, it seems that consumers are starting to take notice that the market had a pretty good year this year, because the University of Michigan Consumer Sentiment Survey, that's a survey that tracks people's views on the market, that surged to 69 last week. And as you can see on this chart, we came from about 61. Now, that's a preliminary reading, so we don't know if that's going to be the actual number, but that's not bad at all. Now, let's also look at our weekly economic round of data. The first thing we look at each week, and that we want to get our arms around, is how is the economy growing right here, right now? And the easiest way to understand that, as you well know if you watch this video series, is the Atlanta Fed's GDP Now model. It's a real-time glimpse into what economic data, as it's being released, means for the growth of the economy. For example, this week we received the wholesale trade release from the U.S. Census Bureau. Now, do you wonder what that is? Well, the wholesale trade report, and again, it's reported by the U.S. Census Bureau. It provides a national estimate of monthly sales, inventories, and then an inventory to sale ratio by the kind of businesses that are wholesale firms and those that are located in the United States. So that report came out this week, and it changed the nowcast for the fourth quarter GDP investment growth nowcast, which is a report inside of the report, which dropped the Atlanta Fed's GDP Now model to a positive 1.2 from 1.3 last week. Still on the plus side, albeit down sharply from last quarter's 5% growth. And the next piece of data is just absolutely fascinating to me. Since the beginning of 2022, we have constantly watched mortgage rates tick up, 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 up. Now, for the first time in 2 years, it seems we've reached the peak of mortgage rates, and we're starting to see a gradual climb back down. The rate on a 30-year mortgage this week has dropped to 7.03%. Next week will be below 7, possibly, if we keep this trend going. The other thing we look at each week is the labor market. And how we gauge that is we look at the initial claims for unemployment insurance. So let's see how people that are going on unemployment insurance for the first time how many people are hitting that number. This week, the number came in at 220,000 new claims for unemployment insurance. And that was almost right in line with what we had last week. So no big claim or jump there. But how about the more troubling continuing claims that continue to rise throughout this year? People just are not coming off unemployment insurance fast enough when they get on unemployment insurance. Well, that number actually did retreat from its post-pandemic high of 1.92 million, and it dropped down this week to 1.86 million folks for the week. So 1.86 million on continuing claims. So good to see that number's coming down. And of course, the last thing we look at in our first point here is the markets over the last 5 trading days. Now, this week, the S&P 500, which is our proxy for growth in income, but only when taken together, that was positive 0.21% for the week, and it barely squeaked out a gain. If we would have ended the week Thursday, we would have been in negative territory, but thanks to a strong Friday, positive for the week. Next, the Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive 1.02% for the week, so continuing its strong rebound near the second half of this year. And finally, the MSCI EAFE, which tracks stocks of developed countries across the world, excluding the U.S., that did actually fall for the week, down 0.05, so barely negative, but negative. And now point number 2. This week we received the U.S. Labor Department's job report for the month of November 2023. The amount of new jobs created for the month of November was 199,000 new jobs, which was a slowdown from earlier in the year, as you can see on your screen, but more than economists were predicting and anticipating for this current month. In November, we saw the largest jobs being created in the healthcare sector, and the healthcare sector was actually able to add a net total of 77,000 jobs for the month. That's above their average. This year, the healthcare sector is averaging about 54,000 over the previous 12 months. The government, hate to see that, but that's continuing to be a top producer. That was the second largest producer of job gains, adding about 49,000 new jobs for the month, right in line with their average growth of about 55,000 each month in the last 12. And most of the job government gains were attributed to local governments, who added about 32,000 of those 49,000 jobs. And finally, the third largest category was leisure and hospitality. That thing's been booming since the end of COVID, and they ended up 40,000 for the month. The largest detractor of job gains was the retail trade industry, which saw a decline of 38,000, and that was mainly attributed to retail department stores laying off folks. The average hourly earnings, which comes in this report at $34.10 an hour, was an increase of 12 cents, and that was about 40 basis points of an increase. Over the last 12 months, the average hourly earnings are up about 4%, so outpacing the average rate of inflation, but right in line with what the inflation we've actually experienced. The average work week for all employees was up about 1/10 to 34.4 hours per week. However, if you work in manufacturing, it was a full 40 hours, which when you consider part-time workers, that means most people that are working in the manufacturing sector are being forced to work overtime right now. And finally, what about the unemployment rate that comes out on this report? Well, last month we actually went up to 3.9% on the unemployment rate, and that was from 3.8% the month prior. Well, this month, November of 2023, we have dropped back down to 3.7. That's right, 3.7 is the national unemployment rate as of today. Point number 3, gold prices reached a high this year of about a 12% gain back in April. Then they took the rest of the year and fell right back down to a big goose egg of 0. That's right, no return. And finally, during the months of October and November, have shot right back up another 12%. So today, they're at 12% growth. Started 0, hit 12, back down to 0, back up to 12. Well, behind the S&P 500 and a good international fund, they're still lagging the stock market. Maybe not the aggressive growth category. Now, why the big run in gold all of a sudden, and who's buying gold? Because as a gold bearer myself, I would argue that there is no purpose for it other than jewelry in our modern world, maybe some manufacturing. And there are good arguments to back up my assertion, which we won't go into. Granted, this is my personal opinion, so take it for what it's worth. It's not any firm level view. However, we just received new data from the World Gold Council that gives us insight into the reason why the prices might have floated up this last month. Now, before I go into that, let me give you a little history. From 2010 to 2019, central banks around the world bought gold at an average of 497 tons per year. At the time, that was 11% of the world's supply. Fast forward to 2022, last year, and central banks across the globe bought 1,082 tons of gold, which is more than twice as much as they did in the previous decade, and now they account for nearly a fourth, or about 23% of the world's gold purchases. So why is there a big jump? Well, you might remember me discussing this in a previous video. And what I discussed was, if you're Russia or you're any other central bank and you're buying U.S. treasuries, that's fine and dandy. That's the safest asset in the world, and everything's priced in U.S. dollars, so that's a good thing to buy until you invade Ukraine and we sanction you to death, freezing your U.S. dollar-denominated assets, which every central bank in the world must hold. So what is something that trades in U.S. dollars but can't be confiscated? Well, you guessed it. We're talking about it. Gold, a physical asset you can put in your vault if you're a central bank. Hence the reason why we've seen a huge run-up in buying, thus a run-up in prices. From the data we just received from the World Gold Council, we can see that central banks bought 42 tons of gold this last month, the largest being China, with nearly half of it, 23 tons. The Chinese total purchases year to date, 204 tons, and at the end of the quarter, 800 tons has been purchased in 2023 alone. I'm not only here to educate you on this point, but just to say, when you hear someone telling you that gold is a safe haven, that's not true. Think about this. Does a safe haven drop 12% in a matter of 6 months? Nope, absolutely not. China, Brazil, Russia, they're not buying gold as a safe haven. They're buying it to hedge geopolitical uncertainty, of which they're still getting an asset tied to the U.S. dollar because gold is traded in U.S. dollars. If you want a safe haven, there are plenty of good options for that right now, such as a 5% treasury bond. You're not going to get sanctioned to death and have your assets frozen. Gold should only be bought as a trading asset. Long-term returns are bad. The future is very uncertain, if not doomed, for the liquid gold. And in our current world, other than the recent buying by central banks around the world, there's just not a lot of demand for it. That central bank buying should continue to drive prices higher, although it's going to have volatility. And if these central banks ever back out, watch out, because they're a fourth of the buying right now. And point number 4, we received the Job Openings and Labor Turnover Survey, or better known as the JOLTS report. This report, which is closely watched by the Federal Reserve, puts out some notable data, including the amount of job openings in the U.S., and that was the biggest takeaway from the latest report we just got. Now, you can see on your screen here, we have been in a steady decline in terms of the number of open jobs, not jobs. We continue to create new jobs, but the amount of open jobs that are not filled out there. Presumably, those jobs are either not being filled and thus being taken off as an open position, or they're being filled. And maybe they're being filled by some of the layoffs we've seen from the tech sector, for example. Those unemployed workers are just taking these open jobs, filling them, before having to go on unemployment insurance. That's why we continue to see our initial claims for unemployment insurance stay so low throughout this year. The ratio of open jobs, and again, that's about 8.7 million right now, to unemployed workers is about 1.3 times. Now, to put that into perspective, historical perspective, since December of 2000, we were normally at a 0.7 times. There are normally more workers than open jobs. Right now, there are more jobs, 1.3, than workers, open jobs and workers. But that number has been falling fast. Chair Powell, Fed President Chair Powell, has constantly remarked about the amount of open jobs being a contributory to inflation and wage gains, and thus there will probably be no rate cuts until the open jobs number to open workers ratio gets back to it in a historical range. Does it need to come back down to 0.07? like we've seen since December of 2000? Probably not, but at least being within one standard deviation of that number, and one standard deviation is 0.4. So that would put it around 1.1. We're at 1.3 right now. So perhaps if we see that number come close to 1 to 1.1, somewhere in that range, the Fed can start to feel more comfortable about the amount of open jobs out there not contributing to inflation, not contributing to wage gains, which contributes to inflation, and thus that would give them the confidence to perhaps start cutting rates. Again, a data point, the JOLTS, numbers that the Fed watches so closely is probably a pretty important number for us to watch too, to get an indicator of, are they actually going to start cutting rates sometime next year? Right now, the CME group says 50% chance that rates get cut in March of 2024, start to get cut and continue to get cut throughout the year. I don't think that happens unless you see a number like this start to fall to a historical range. It's getting close. As you can see, it's continuing to fall. Those open jobs are continuing to fall, which is taking pressure off of inflation, but it's got to fully commit and get back to this historical range before the Fed says, hey, we'll start cutting rates again. Now, maybe not. We could be wrong, but these are all data points that are very important to watch if we want to think about what the Fed's going to do, and what the Fed does possibly attributes to partly how your stocks perform. Not completely, but partly. So thanks so much for watching this week's video series. If you enjoyed this video series, would you do us a favor? You can do us a favor by hitting the like button and the subscribe button. The like button pushes our content out to more people by helping the algorithms know that the content was helpful, as well as hitting the subscribe button allows everything to get pushed out to you as we release it, including our end-of-year conversation with our own CPA of Whitaker-Myers Tax Advisors, Cage Rush, who's going to go through some important year-end tax planning considerations and some things to start thinking about for 2024. It'll be a webinar you won't want to miss. So if you'd like to attend it, talk to your financial advisor, who would be more than happy to get you an invite to that webinar. It'll be a 1-hour webinar here in a few weeks. Thanks so much. And if you would like to meet with any of our financial coaches or advisors, go to the comment section and hit the link in the comment section where you can be set up with a financial coach who will help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, live debt-free, hold you accountable to your budget, or you can meet with a financial planner who will help you in baby steps 4, 5, and 6, and they're going to help you start that Roth IRA, make sure your 401k is optimized and invested well as do all the financial planning you need to make sure that you can feel confident about your tomorrow. Thanks so much. We'll look forward to seeing you next week.